is the Investor Connect podcast program. This is Hall T. Martin. I'm the host of the show, in which we interview angel investors, venture capital, private equity, family offices, and many other investor groups for startups and growth companies. I hope you enjoyed this episode. Thank you for joining us. Hello, this is Hall Martin with Investor Connect. Today we're talking about Dave Blivin, founder and managing director of Cottonwood Technology Fund. Dave has spent decades working at the intersection of science, capital, and commercialization, helping turn complex technologies into real companies. Through Cottonwood, he invests in early-stage deep tech and hard science startups built around strong intellectual property, patents, and breakthrough innovation. Cottonwood focuses on areas like photonics, advanced materials, sensors, medtech, energy, robotics, and advanced manufacturing, backing technologies that are often too technical, too early, or too outside the traditional venture capital playbook for most investors. Dave, thank you for joining us.
Thanks, Al. That was actually a pretty good intro. Thanks. Very comprehensive and pretty accurate.
You've been quite busy over the years with this, and so looking forward to catching up with you today about it and see where are we with it today, since things are always evolving in this space. But maybe you can tell us about the evolution of Cottonwood Technology Fund and its current investment thesis in deep tech.
Yeah, so we've always been focused. We started Cottonwood in 2009, started making investments in 2010. Prior to that, I was in the Research Triangle Park in North Carolina and had 3 funds that I started and built there before selling it and moving to this region. So in this region, I started in Santa Fe. I'm now in Denver. But we've always had a regional focus, number one. So we've always been looking at opportunities in Texas, Colorado, Arizona. Of course, I was based in New Mexico. I now live in Denver, but my partner, Lee Rand, still lives in Santa Fe. And then in 2014, we expanded into Europe. And so I have 2 partners in the Netherlands, and we do the same thing in that kind of Northwest Europe region as well. To your point, we don't really have an industry focus. We've invested across, surprisingly, over 30 companies, and none really directly competing with each other, all in hard tech across a number of different industries, including even health sciences. Always early, many times pre-prototype, or in many cases funding, the first prototype or proof of concept. And then what we do is try to open doors to customers, try to open doors, of course, to next round investors, help build a team. We're always basically lead investors. We're always on the board. We're still on the board of every company we've ever invested in that are still active. Even some that have raised several $100 million, we've been able to maintain a board role. And I take that personally as a compliment, and just in terms of they're not trying to kick me off the board. They're usually trying to keep me on the board. So I feel like I'm adding a little bit to their strategy and success. Real quickly, I would say, the 2 things that we do a little bit differently, I think, is even at that early stage, we're investing not 200 or 250,000 or whatever. We're investing in general around 2 million. And we'd like to syndicate. So these early pre-seed rounds can be 2 to 4 million. And the main reason for that is because we're doing hard tech. You actually have to build something. It has to work according to some, customer specifications. It's the first prototype, so it doesn't have to be commercially viable yet, but it has to be representative and kind of paint that, credible path to a commercial product. And so that takes time. You can't just throw up a website over the weekend. You got to, really build something. And you almost always need a business person on the team. Not necessarily, of course, you don't have a product to sell, but you do have to raise the next round. And next round investors expect someone who knows what they're doing related to, running and building a business. So by having these larger early rounds, we can fill in any skills in business development or management to position for the next round. And then the other thing we do a little different, I think, is we have built an extensive network in the corporate venture community. And every big corporation today has a venture group. They pretty much no longer innovate internally. They partner with funds, they partner with startups, they partner with universities for funded research. So they're always looking for new innovation from outside the corporation today for the most part. And by building that network, they help us with due diligence. They're not usually in our round because it's too early, but once we have that prototype or proof of concept, their own people can do their own validation and testing. Almost every company in our portfolio has a corporate venture investor in their next round.
Well, that's a great overview. Appreciate the updates there. How do you evaluate patent-based technologies before commercial traction exists? What leads you to invest in one deal versus another?
Yeah, we're generally, I try to define it in different ways, but I kind of tend to use the terminology off the curve. But what that means in practice is virtually no prior art. So I would say a majority of companies that we see, a majority of quote innovation is incremental to what's already in the marketplace. It's a little faster, a little cheaper, maybe a different material, but not disruptive in the sense that it's really changing the metrics in an industry. And so we're looking for innovation. Quite often it's serendipitously kind of discovered. It's not on the expected path. Someone accidentally does something and can't explain why it happened, and it stumbles into a new way of doing things. And so if we went through our portfolio, I would say every company kind of falls into that general description of virtually no prior art or no prior art, a whole new way of doing things. Disruptive potential if it works. We're trying to support them early and prove that it can work. Chance to be an industry standard if it works, become kind of a new way of doing business. And so when you put that screen on it, not that many companies that we see would fit that screen, right? And of course, looking for large markets ultimately as well. So it's got to be a chance for an industry standard. We're looking not for 1% market share. We're looking for companies have the potential to be 10, 20, 30% market share once they prove the technology works and get in the market.
Great. Well, what are some of the lessons you learned from investing over $1 billion in fundraising and exit value across multiple funds that you would like to share today?
Well, not surprisingly to probably anybody listening, people are always the key, right? So, we've invested in, like I said, over 30 of these companies, disruptive potential. What's been surprising to me, 100% of the time, every single company has delivered, working technology. So, these are, I would say, in diligence, we often do hear, oh, that won't work from the so-called experts who have seen, people come with different ideas and different innovation over time. And we'll kind of test their interest in a technology that we might come across. And again, they might, and quite often, probably majority of the time, we'll hear, oh, that can't be done. That's when we get interested. But at the end of the day, notwithstanding that they've all successfully delivered working prototypes, working, proof of concepts, doesn't mean we have all successful companies, right? And so it comes down ultimately to the people. It comes down to the ability to raise additional rounds of capital, which gets back to my earlier point about getting a business person in there, because we're not looking necessarily for, an experienced business person to be part of the team at our stage, but the next round investors are. And if we don't fill that gap early with a credible candidate that can, we can open doors, of course, to customers, to investors, but they're not going to invest because they like us. They're going to invest because they really get excited about the company. And if they get excited about the company, they expect and they do want someone there that knows how to spend the money in a smart way, create value, has done it before, that they can kind of count on to execute the plan. And it's not usually, it depends on the company, but it's not usually the founding technology folks. Like I said, they've always been able to deliver working technology. Doesn't mean they know how to build a company. Doesn't mean they know how to, sell the product, if you will.
Great. Well, you work with national labs and research universities to commercialize these breakthrough technologies. What are the benefits and the challenges in working with those groups?
I would say the universities are actually not that hard to work with. They have, tech commercialization folks. They do this with a lot of different parties. They've, I think, fine-tuned their approaches over time. National labs are a little bit different. Sometimes, especially New Mexico, I don't know, I don't want to get down on New Mexico, but the two New Mexico labs, Los Alamos and Sandia, because they're what they call NSA labs, national security labs, they just have a lot of different rules about, even restricting the scientists from working even as a consultant on the companies that they might be the founder of the technology on. So It makes it difficult sometimes. I mean, they're not often wanting to leave the lab environment to join a startup. They like the security and they like to do their research. They're not necessarily a good fit to be at a company full time. But it makes it a little bit more difficult if you start a company based on coming out of the labs and then you can't really interact with the person that invented the technology. It makes it a little bit more challenging. So I would say, we've invested in a number of companies that have ties back to lab-based technology. But in general, those hurdles have already been kind of crossed by an entrepreneur who's licensed it, gone through the pain of getting it out of the lab, and it's kind of got the company started. So we're not having to deal with that part of it.
Right. Well, what are some of the common mistakes founders make when they're pitching deep tech investors such as yourself? What do you see as the biggest challenge there?
I think there's always a tendency, and even more of a
Mhm.
tendency with the companies that we back, and especially given that, almost any hard tech company is going to be started by, hard tech people, right? And they are really excited about their technology and they really want to dig into the details of how it works. And they'll have 20 slides and 15 will be on technology. And it's not that we're not interested in the technology, but we're ultimately interested in what's the business opportunity, right? What's the investment opportunity? And so by ignoring or kind of assuming that that's the easy part, getting into the market and attracting customers, I think there's a predisposition from many of the inventors that this is so disruptive. It's just going to be like, the better mousetrap theory that you always hear about. It never works that way, really, ever. I've yet to see just sort of, customers come flooding in the door as soon as they hear about some disruptive technology. They're always skeptical. And in fact, I think our companies have a harder path into the market, believe it or not, for some of the reasons I stated before, which is there's a predisposition that, oh, this won't work in many cases because it is disruptive. So, yeah, they're interested if it works, but they're skeptical. And even if you get some of these early prototypes and proof of concepts, they're still not sure it will scale. They're still not sure, if it'll compete from a cost standpoint. It's always easier from the big company standpoint to just do these incremental improvements on proven technology that the customers already know, they already understand, they know it works, they know what it costs. Now it's a little bit better. So trying to shift people to something new, even though it might be way better, there's a lot of inertia that you have to overcome. And so the expectation that, the technology will sell itself is never true. And I think that's the biggest mistake in terms of these early presentations of disruptive ideas is a kind of a belief that the technology will sell itself once they kind of demonstrate it. And it just doesn't work that way.
Right. So, what are the insights from the book Crossing the Chasm on Building Successful Technology Ecosystems Outside Silicon Valley? How do you apply that to your work?
Well, it's a byproduct of my work, of course, right? So I mentioned I started in the Southeast and now we're in the Southwest and we're in Europe. And so what I found and have found is you need three things ultimately to be successful as a company. You need, of course, the idea, and you need money, and you need management, back to the people part. What I've found is there's great ideas everywhere, especially in hard tech. You've got great universities in every single state that surrounds us, in every single state in the country, every country in the world. We're being in the Netherlands. I mean, there's great research universities and national labs in the Netherlands and every other country. And so, the book kind of goes into, it's not about investing per se, it's more of an economic development focus. If you talk to any mayor, any governor, any, president of a country, they will consistently say that they want to see more successful tech commercialization as a pathway to job creation and economic diversification. Unfortunately, they kind of default in trying to execute on that plan to let's go to Silicon Valley and see what they did, or let's try to understand what Silicon Valley did, or let's try to understand what made Silicon Valley successful. And that's just not something you can expect to duplicate if you're not Silicon Valley. I mean, it took 50 years and it's just a unique confluence of resources out there that kind of fed on itself. But you can be successful by focusing on these other two categories. And so you can assume essentially the ideas are there. What you need is capital, looking for them, and you need management capable of building companies around them. Typically, if you look at New Mexico or almost any, even like Texas where you are, I mean, especially early, especially hard tech, there's just not that much capital and certainly experienced capital that's actively looking for hard tech. There's been a predisposition over the last 15, 20 years, ever since sort of the internet started, that software can do almost anything, and software is faster, software is more scalable. And so there's been a predisposition to look for quicker exits and scaling of software versus what started the venture industry, of course, was silicon and the chip and the applications of the semiconductor, et cetera. So, I mean, the venture industry started as a hard tech industry, but it's really shifted almost every fund into soft tech. So, the book just gets into how do you solve for these other two areas generally in terms of money and management. And the main conclusion to jump to the bottom line from my experience is what I figured out when I was in the Southeast and started learning the business. Everybody would say money follows management. It gets back to the people point I made earlier. And I think it's a smart strategy if you can follow it. But if you're in the Southeast or the Southwest or in Europe, you don't have this deep history of successful venture-backed exits, recycling of entrepreneurs around every corner. And so as I talked to these folks and they said, money follows management, I'm like, well, I may not be able to make any investments in my region because we don't have the management with the track records that you could really bank on. And I had an epiphany at one point to say, well, maybe I can get management to follow money. And what that means in practice gets back to what I said earlier. We're putting in 2 to 4 million even at the pre-seed stage. And it's largely to solve for the management question, right? It's largely to be able to be credible in recruiting management. You can't recruit anybody new to the team by putting in $200,000, and you can move the technology forward, you can move the customer interest forward. But when you go to raise the next round of capital, those investors generally are going to want to know who's running the company, what's their track record of success. And if you don't have a good answer to that, it's hard to raise the next round of capital. So if you're a state or a city or a country, early technology investing is done locally. You're not getting folks from California come invest in New Mexico at, pre-product stage generally. Or if they do it, they're going to move the company to California, which is not the answer you want if you're in New Mexico. So if you want the ideas to build companies in the area where they were invented, you have to have the capital resident, and then you can leverage that capital to recruit management and start to build the companies.
So there's deep tech research around the world. Why is Cottonwood focused on the Southwest U.S. and Northwest Europe for deep tech investments? What's special about that?
Well, they're very deep. As I mentioned just in the last answer, I mean, there's good ideas everywhere. So we're able to find great ideas. You could say it's less competitive in terms of, term sheets, et cetera. I don't know if that's a plus or a minus because you'd like to be able to syndicate with other investors. But we just feel like there's a lot of overlooked opportunity to invest. There's an arbitrage, of course, in terms of valuations. So when we're, leading these deals in regions where it's hard to find capital, pricing can be, we're not draconian about it. We try to be like a partner with the entrepreneurs, but nevertheless, you can usually structure deals a little bit more attractive than you might get in California. For us, we just feel like that's where we have unique understanding and expertise is how do you do this outside of California? And I think in California and a few other places that are rich in capital, there's a tendency, quite honestly, Hall, you probably see this. I mean, there's a lot of what I'll call momentum investing, where it's just, who's in the deal, it's Kleiner Perkins or it's Battery Ventures or somebody. It's like, oh, how do I get in that deal with them? And it just sort of escalates up a bit just based on who's behind the deal. And they try to go big, quick, and get out, large. And the big funds can kind of pull that off sometimes, but small seed stage funds, and especially in hard tech, you really can't. You can't just create momentum and exits. You got to, like I said, build something that really works. And so outside the kind of hot spots, there's great ideas that can be leveraged. It's more, I'd say, stable to build management teams. You're not being poached by the next hot deal every other week, with people trying to, leave for another deal. Yeah, there's not another hot deal in New Mexico next week in most cases. So you build your management team, you can really kind of build continuity, which I think is important ultimately towards success. And then we've been able to be very successful again raising capital. Our companies have raised over $1.5 billion in follow-on rounds, and it's largely again because of our corporate network and our ability to get that credibility behind the hard tech ideas, get the corporate sponsors that really signal to the market that the technology has market promise.
Great. Well, so what do you see as the future of deep tech investing in areas such as photonics, advanced materials, robotics, climate tech, and healthcare innovation? Where do you see this going?
Well, what's been interesting, there is a shift, I think, starting to occur back towards hard tech in general. I think AI has kind of driven that a little bit, where a lot of software companies that were able to be started and grown quickly. AI is like if you take software as a service, a lot of the funds were, heavy into software as a service. A lot of those companies' business plans are a little bit under attack now with AI because a lot of stuff that was sort of a unique capability can be duplicated quickly with AI. And so a lot of those companies are really searching for what's their differentiation, what's their sustainable advantage. And all of that is highlighted with the need for data centers, the need for faster chips, need for cooling. You do need real technologies. It can't all be software for the next generation, whether it's quantum, whether it's AI, which is kind of the next generation of computing. These new materials, all these areas are areas that even with space, right? You can't do space with software. You got to have, real materials and real, fuel systems and cooling systems and electronics that are radiation hard. And so all these kind of new emerging areas are just highlighting, I think, for a lot of people that, I'm not saying software is dead. Certainly, you can always have software. AI is essentially software. But the need for hard tech has never been higher, I think. And so we're pretty excited about our experience in this area and our ability to leverage that going forward.
Right. Well, the last few minutes that we have here today, what else should we cover that we haven't?
We've covered a lot. I don't know. So, again, I think in terms of new innovation, it's never going to slow down. It's only getting faster, right? And for us, I think, our focus, I mean, you mentioned earlier, we've done quantum, we've done materials, we've done semiconductors, we've done even health sciences. There's a lot of innovation continuing in health science areas in terms of early detection, better drugs, better targeted therapeutics, et cetera. So, I don't know what else I can add, Hall. I would say we're as excited now as we've ever been.
Well, great. Well, appreciate the update on what you guys are doing there. How best for listeners to get back in touch with you?
Yeah, well, so our website is just cottonwood.vc, like Victor Charlie or venture capital, Cottonwood like the tree. And my email address is just dave@cottonwood.vc. So I'd love to hear from anybody who has additional questions, like to learn more. And then my book, if you're interested in this area, I think there's a lot of insights and experience in the book called Crossing the Cactus, and you can buy it on Amazon. So I'd love to have folks read that. And again, I get a lot of feedback from that book from people, and most of it's positive. So if you have ideas or thoughts or comments or questions after reading the book, I'd love to hear from you.
Great. We'll put all your contact details in the show notes. I want to thank you for joining us today and hope to have you back for a follow-up soon.
Very good. Thanks, Hall.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.